For Morningstar, I'm Adam Zoll, and welcome to the Friday Five. Today, we're at the Morningstar Investment Conference, and here with 5 key takeaways from the conference is Morningstar's markets editor, Jeremy Glazer. Jeremy, thanks for being here.
You're welcome, Adam.
So the first thing you have for us involves emerging markets bonds. What did you learn?
It does. Michael Hasenstab kicked off the conference with a discussion of why he's liking emerging market bonds right now. It was pretty fascinating, and his big takeaway was that the market tends to treat the emerging markets as this monolithic whole, that either they're really euphoric about them or they're just totally down to the dumps on them, and that seems to just rotate on these 6-month cycles. He says that's not the way investors need to approach them. They really need to do fundamental analysis, look at the credit, look at the current account deficits that are happening in each of those markets, and make sure they place those bets in the right place. That's why he has kind of these contrarian bets in places like Hungary or the Ukraine, and I think that was probably a good lesson that you can't treat all of these markets the same.
From emerging markets bonds to emerging markets equities, there was also discussion about how how international investing in general is sort of changing in its complexion.
There was a conversation with David Harrow and Rob Lovelace and Harry Hartford just about how challenging in a lot of ways and how blurred the lines have become in international equities because so many companies do have that global scale that they're selling into emerging markets, they're selling into developed markets, and where they're domiciled may matter less. And the way that they think about it is that you think about the story in China or in other emerging markets. That the exciting part is that you have this growing consumer middle class, these growing purchasing power, but that if you look at the companies that are domiciled there, you're looking at financial services companies that might not be all that attractive, at commodities firms, and they wondered if you're excited about the growing consumer, you probably don't want to be in commodities. You want to be in places like autos or in other kind of consumer-facing goods, and that they might look abroad to get that exposure, outside of those locally domiciled companies to get that exposure. That's the way they invest. You have to be objective-based. You can't just look at those benchmarks.
Our keynote speaker at the conference this year is Bill Gross, founder of PIMCO. He spoke about this new neutral concept and what it means with regard to what's going to happen with interest rates. What did you hear from him?
This has been a theme that PIMCO has been pushing for a couple months now, of that interest rates and Federal Reserve, and all central bank policy might remain a lot more lenient for longer than many people are expecting. That growth is not going to all of a sudden come, roaring back in any meaningful way, and that the banks are going to have to remain in a very easy monetary policy mode, and that therefore long-term rates may be lower than we've seen in the past, and may be lower than many are expecting right now. And we can really see how that is playing out in terms of their portfolios. You look at something like unconstrained bond. We talked to Mohit Mittal, who's one of the managers there, and he's saying that they're going out on duration, that they're taking more duration risk, because they see rates as maybe not rising as fast as many other in the market expect, and that he's a little bit more hesitant on credit risk, that's something that they're being very careful about.
Well, from interest rates to withdrawal rates, you chaired a panel on retirement and withdrawal in retirement. What did you hear from the panelists there about whether the so-called 4% rule is still applicable?
I'm not sure we came to a really clear conclusion about if it works or not, because there are so many swing factors that it's really almost impossible to say if it's going to be right for any individual person. But there was somewhat of a consensus that maybe that 4% rule is a good starting point, that in Michael Kitces generally argued very heavily that at that 4% rule for most people, they're going to be fine under almost all market environments, and that's really sets that even if in a low return environment, you'll be able to have enough money potentially without having to make big adjustments. But others like Alan Roth were a little bit more cautious, thinking that because you have things like fees, that because investor behavior isn't perfect, you can't really count on things working just like the model is going to be. What the model predicts, and that 4% maybe is a little bit too high, that you have to tack that down maybe even as low as 2.5%. That's a big difference. It gives investors in retirement a lot to think about, but the real key being that these really are just rules of thumb, and that you have to use common sense. You have to look at your spending habits. You have to continue to rebalance, think year to year when you're making those withdrawal decisions. You can't just set it and totally forget about it.
Another hot topic has been so-called strategic beta funds. Some people call them smart beta funds. These are index funds with a twist. What have you learned about those?
They are. Strategic beta is, the idea that we should have index funds that aren't market cap weighted, that there's other ways to look at, kind of these rules-based indexes, that maybe you're trying to capture a momentum factor, maybe you're trying to think about value funds or a size factor that you're trying to gain exposure to. And the jury's, I think, still really out. And from talking to people at the conference, the jury really does seem to be out of if these are going to be useful for investors or not. There's a camp that really sees that this is going to kind of improve people's risk return profiles. They're going to be able to gain access to these better types of investments. It's going to be a net positive. There's other think that maybe it's more marketing driven. A lot of these strategies, even though if they work in back tests, when you actually put them into practice, they won't work as well, or perhaps whatever arbitrage opportunities are there will be competed away. Kind of lose any of that excess return, that it might not work as well. I think the truth is probably in the middle. There's going to be some funds that are going to be useful, that are going to find them ways into investors' portfolios. There'll be others that aren't, and we're going to have to continue to do research, continue to know what you own, be careful with them. But it definitely is an interesting part of the market to keep an eye on.
Jeremy, it's always great to hear from you on the Friday Five. Thanks for sharing your insights on the conference.
You're welcome, Adam.
For Morningstar, I'm Adam Zoll. Thanks for watching.